So today we got the news that we've been waiting for 2 months now, or did we get the same news that we got 2 months ago? So that's the question. It appears that we got the news that we've been waiting for 2 months since the original Phase 1 deal was announced back in October. It was announced again today, and looking like there might be more of a deal today than there was back then. And the market has really broken out as a result. So we're going to talk about what that breakout means. And the fact that that we're overbought might be actually a really good thing from a long-term viewpoint, even if it's not necessarily a great thing in terms of setting up some divergences in the short term. So I'm going to show you all that in today's video. We're going to talk about a sector that's really been beaten up, that had its own little breakout today, and we'll look for our trade idea in that beaten up sector. So let's go ahead and get started. Today is Thursday, December the 12th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 first with the Market Forecast Indicator. You can see that we have a strong bullish posture, long-term market sentiment line still above 80. Here's our breakout, the breakout we've been watching for. We got the news today. Actually, the news today, if you go back and look at the headlines of October the 11th, the news today is almost the exact same as it was on this day. Now, since that day when the news came out that there was a deal reached in principle on a Phase 1 deal, then now you can see what happened afterwards. Of course, there was some back and forth about whether that was actually going to come out. And then we had maybe we'll wait till after the election, drop, buy the dip moment here. But you had that big, long 20-day intermediate or near-term rally because nobody wanted to not be bullish heading into the actual deal being announced. And today there's some idea that this is the actual deal being announced, even though the actual headline is the same as it was on October the 11th, that there's been a deal reached in principle on a Phase 1 deal. But it was bullish nonetheless, just like it was then. It's bullish now, just more bullish now than it was then. We almost got a cluster today, which is significant because this would have included the market sentiment line, and the last time that we had a cluster with a market sentiment line above 82 was right here in April, coming off of that big old run that we had. And before that, you can see it was all the way back over into here was the last time that we had a cluster with the market sentiment line above 80. It looks like close to one right there, actually, one right there too. So you can see there was some volatility that occurred after that. But on the flip side, in terms of a good sign, you'll see that, okay, well, we got a cluster on the weekly. In fact, we got a couple clusters on the weekly chart, but this includes the market sentiment line crossing above 80. Well, if you notice, when the market sentiment line crosses above 80, it can stay above 80 and have multiple clusters. So if you look at back here in 2017, at the early part of 2017, we got a cluster right when market sentiment line crossed 80 then too. A little bit of a breakout move after we had broken above to new highs. We got a little bit of a breakout move early part of that year, and then we really rallied. In fact, over the course of the next year, we had 3 more clusters on the weekly chart with the market sentiment line above 80. And if you look at the monthly chart here, we got a cluster in fact, we've gotten a bunch of clusters with the market sentiment line being above 80. But you notice we look very similar to this period where we had a bullish period. We had a light pink shading yellow line, light pink shading yellow line. Here's those first couple of clusters in 2016. Right after that, that bounce, same thing. Here's the first couple of clusters right after that bounce. And then, like I said, on the weekly chart, we went into a pretty good, strong period of 2017. Are we going to get something similar? It looks like we are really, really bullish here. But the reality is, if I change the chart here to a log scale, you'll see that, not so bullish now, right? It does look kind of normal up here. Now, it's way far up to the right, but it's not parabolic like it looks like on the regular arithmetic chart. So the idea is that we get these overbought signals, but I tweeted this out. Let's see if I can find it here. Give me 1 second. I tweeted this out. For those of you who follow me at DavidSettle42 on Twitter, this idea that an overbought signal doesn't necessarily mean sell. A lot of times overbought signals are signs of trend change, and that's kind of what I replied here, is, and those who have been taking my technical analysis class know this full well, is a lot of times a good overbought, you need a good overbought signal to get a trend going at the beginning of a trend. And like I said, on the monthly and weekly charts, it kind of looks like we are closer towards the beginnings of a long-term move than we are towards the end with these clusters. Now, we might be towards the end of an intermediate run. We might get a little bit of an intermediate pullback. We've seen evidences of that before, but that doesn't necessarily mean it wouldn't necessarily be a trend-changing pullback. If you notice back on the chart here, that we can get a pretty decent pullback here on an intermediate basis, even down to the 50% line, to these old highs, and still be a much, much higher low compared to the last intermediate low point, if we were to get an intermediate pullback. I don't necessarily think we will, but if we did. I think if we're going to get any kind of intermediate weakness, it will just be the green line coming down below 80, similar to what we saw on that wait till after the election dip that we have. I also tweeted this out. No, not that one. It'd be this one. Over the last 200 days, you can kind of see technology's been good and energy's been bad and everything else has been flat. That's not really a sign of a really mature long-term trend. This is a 200-day chart. Here is the peak in October of 2018, right before we had that big, last fourth quarter. It was so horrible. Well, look at the safety trades and how bearish they were, and look at the cyclical trades and how bullish they were. Here's the January peak in 2018, and same thing. Look how bearish the safety trades were and how relatively bullish the cyclicals were. So, to put it in context of what we're looking like right now, the tech sectors look great, but nothing else does in the cyclical world, and we're hardly oversold. In fact, we're still coming down from really strong gains in the safety trade. So again, another sign that we might be closer, even though there might be some intermediate weakness coming up. We are closer to the beginnings of a long-term run than we are the end of one, based off of some of these signals. And not only this, but also our asset selector tool that I shared in today's portfolio management class tells us the exact same thing. Yeah, things are starting to look bullish, but the key word there is starting. On a long-term basis, they're starting to. We hardly look mature on a long-term basis at all. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our YouTube logo or our Market Scholars logo right here, and then it will hit a red subscribe button. That'll pop out. Click on that, or there's a subscribe button down below the video too. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, that you liked our video today, and number two, you want us to do it again tomorrow. So it's our survey. It's a quick way for us to get feedback. We look at how many thumbs up there are relative to our views every video to see what you think. And then finally, comment on what stood out to you. What stood out to you? What do you think about the video? What questions do you have? You can post those down below. Join our website at marketscholars.com. You can do that for free with this link right here. Click on that link. Pulls you up to a sign-up form. You get access to our Market Outlook forum with other market scholars in our community. You also get access to our market commentary portion of our blog and webinars that we do here and there, as well as other things. Follow me on Twitter for more content in between these videos from day to day, and join our Facebook, our Market Outlook Facebook group that we've created. All right, if you're watching this on our website, I invite you to check out some of the other things here that we have, including a link to our Market Outlook live sessions where we manage the trades we do in these videos all the way to the close. That's kind of a distinction we use here on the Market Outlook. A lot of people will tell you what trades to make. They'll give you trade ideas, but a lot of times they won't necessarily manage the trades going forward. And so you don't ever hear about them again. And we do that. We manage the trades all the way to the close and talk about them and how to manage them. That's what we do in that video. And we also put on today's trade idea before the market closes. So we've actually already put on today's trade in that video today. Here's an upcoming class. As you can see, I got my technical analysis class. If you want to check that out, all you need to do is get the monthly subscription. For more details there you can get the plus subscription plan right here. That gets you access to all 8 of our classes, including that technical analysis class that's coming up here. We invite you to engage with us on social media. You can either click this heart. It opens up a new window where you can like today's Market Outlook tweet. Click that thumbs up. It takes you to your Facebook page. You can like today's Market Outlook Facebook post there. The more you engage with us on social media, the more those platforms will promote our content to the top of your timelines when you log in. That way you don't you make sure you don't miss anything that we put out there from day to day. They only do that with the content you engage with. So we try to make it really easy for you to do that there. And you can see other market scholars that are on the website here recently, another top post from before. All right, if we go back to the charts now, and we take a look at the weekly chart, and you see how bullish it is. We're continuing to move higher, and the PPO is still moving higher, which is the gap between the 50 and 200-day moving averages. Excuse me, that's getting bigger. You can see we had one transition candle that didn't turn into a bearish candle, obviously, this week. So it's 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks now that we've been on this run. That's why I say the intermediate run's kind of getting. Of course, the near-term rally has been up and down, up and down, up and down, and definitely, one idea to kind of keep an eye on with this near-term line is we're already up to higher highs, and the near-term line's not, and this would be, we're already above that high, and the near-term line's definitely not above. So keep in mind the divergences in the short term, especially with the choppiness and the long run that we had there, but also the intermediate run, according to the weekly chart too, is relatively bullish. And then on the weekly chart, if you look at the 3 green arrow chart here, the 2-line basis, you can see the MACD has turned positive. Don't expect it to be too positive, right? We have our surge initially, and then we kind of get some ups and downs afterwards. So expect it to come up, maybe up towards 2, but probably not back up to these highs again. And again, that would also set up for a pretty significant divergence if we can't get back above that high, considering that we're already above that high on this line. Same thing with the stochastic indicator. So those divergences are definitely something to keep an eye on, because the low point between those highs would be the target for that divergence to pull back. And if you go back to that market forecast chart, that's right in between actually the 23 and 38% Fibonacci retracement. So at the very least, we'd be looking at 3,100, if not down into the 3075 area for a pullback on that if that divergence plays out, which again would not be trend changing in the long term. It might bring the intermediate line down below 80. I don't even think it would bring it down below 50. But in the short term, that divergence can play out. We can get a pullback. The market can go crazy, but the reality is it wouldn't change anything in the long term. As we showed you before, we're a lot closer to the beginnings of a long term. Now that could be wrong. Anything can come out and throw all that technical analysis. I saw a funny meme today. Brandon shared it on Twitter. The funny meme that President Trump holding up a sign that said, "My tweets trumps your technical analysis every day," or whatever, something like that. So it's like, yeah, something can come out to throw all this technical analysis out the window. But barring that, the environment is setting up for a short-term pullback, but the beginnings, still in the early innings of a long-term bullish move. Now let's take a look at an intraday chart here, and we'll drop down to the intraday chart, and you can see the 4-week range now has pushed itself out to about 10 points plus. 16 points is that 5% stretch on the rubber band. So you can see we got some room to continue to go up to the upside. Very little volume. Again, the further we go up, the further the tightrope gets away from the ground. And right now the ground is at the very least 314, if not down to 312, where there's a more significant level of volume over the last 20 days. If I were to zoom this out to more of a longer term view of this, then you can see, here, let's put this on an hourly chart. Over a longer term view of the 90 days, you can see that same 312 area right here. That's kind of like your last little node that you've got, your biggest node. A little bit of one there at 314, but not nearly as big as this 312. And then after 312, you got this 309 and then nothing. So the higher the tightrope gets, the more likely we get those kind of divergences that we've seen. If you take a look at today's volume, it actually ended up being pretty strong. Here, let's pull up the volume chart. You can see we ended up with 1.5 times the average volume on this news. Big range. So kind of a breakout range in volume here. When you look at this right in conjunction with, it's actually this one here. 96 million is right there, so it's not overly bearish. If we continue to get this, if we got a downward move at a similar range of almost 4 points and 100 million volume. If we got a similar move like that tomorrow, but with a down, that would not be a good sign. So having one in the breakout type situation is still relatively bullish, but now expect some really quiet and small moves going from here, as you see your ATR is already really low, below 1, and when you on a relative basis, and then your VIX as well is also really low. I mean, not extremely, but it's coming down, and a break back down below 13.5 means here we go on the next near-term run to the upside. But if we hold this support and kind of bounce back up towards 16 on any kind of divergence pullback, then we still get some choppiness before this, and maybe even some intermediate weakness before that long-term bullish trend kicks back in again and we get going. You know, considering the patterns that stocks have when you have a news announcement or you have an expectation and you spend this whole time pricing in that expectation, and then you finally get the what you expected, excuse me, there's that phenomenon of buying the rumor, selling the news that could play out as well. You know, a little knee-jerk reaction to the upside immediately upon getting the headline, and then profit taking on all the expected move, the expectations that we had, and really good run that we've had going into that expected headline. So that could play out into a volatility kind of holding support level here and then bouncing back up without breaking down. But if you break down 13.5, we're going to get this is going to be another extended near-term run that will keep this intermediate run, which is already 2 months old. Will keep it going into that third month, which is kind of the long end of its normal range. So what do you think? Do you agree with that technical assessment, that summary? Do you not agree? Let me know. There's a link popping out right there in the top right corner of your screen. It opens up a poll, and you can vote either agree or disagree. If you click on disagree, comment down below in the YouTube section here, in the comment section, and let me know what you see that suggests otherwise. You know, whether or not you think we're just, we're heading up to the moon now. Now we got this announcement, or you see more of a shakeout. Maybe you think we're closer to the end of a long-term run than we are the beginning. So if there's something that kind of drives that opinion, share that with the community, with our Market Scholars community, and other viewers of the Market Outlook videos down below. All right, as we look at what's driving the price action, of course, we all know what drove it today. So initially it was tweets early in the morning, and then it was a meeting at the White House in the afternoon, and then the announcement that the phase one of the exact same announcement that we got on October the 11th. So if I were actually to go back and take a look at October the 11th and how that played out, here's what it looks like. So here's the, let's do this. Let me detach, and I will bring it up over here, and I'll do October the 11th, 2019, and we'll go to right there. Do the same 10-minute period. So here is is almost picture perfect, but here is the move coming out of that. There's the October 11th news, right? Look at the international, look at crude oil bounce up, look at emerging markets here, crude oil, small cap stocks took off there relative to the S&P. A little pullback late in the day that we didn't get here. Of course, it was a weekend. And you can see down here at the bottom, safety trades, gold, bonds, real estate, gold, bonds, real estate, global bonds. The U.S. dollar was down on that news. U.S. dollar was relatively up and down today, but you can see that the dollar itself, if I take a look at a long-term chart here, and let's actually zoom in on this to like the last couple of years. If you take a look at a candle for the dollar index, it's looking pretty bearish. I mean, the Hakinyashi close is dropping below the 200-day moving average. It's a pretty bearish candle after not getting up to a higher high here. The PPO was falling. Now, granted, that's bad for the dollar. That's actually really good for equities. When the dollar is in, a death cross environment, and we're getting relatively close to one, but when the dollar is in a death cross environment, that's a really good bullish time for equities. Stocks tend to do very, very well, as you can see during that 2017 run. If I were to zoom out even further, you can see that 2013, 2014 run coming off of 2012 when QE3 was announced. So a weaker dollar is not a bad thing. And I don't even think that we get that weak of a move. We would most likely get, now that we can get rid of this drawing here and throw on the Fibonacci lines from that low up to this high point. You can see a move down to 95 would simply just be a Fibonacci retracement. These old lows at the beginning of the year, that's kind of the first layer of support, I think, where the dollar would get to on any pullback, and that would mean, generally speaking, that international stocks, especially emerging markets, might really benefit from that. You would also see potentially energy, which has been so beaten up, could benefit from some weakness in the dollar. If you take a look at the different foreign markets and how they perform, look at the breakout. Look at the breakout on China, getting back up above light green shading again. Light green shading in Korea. Look at that breakout move. Light green shading back on Italy and India. I mean, all breakout move. Brazil's broken out to new 3-month highs. Russia's breaking back out. Germany's continuing. It's a good run. So really strong. I mean, again, back in last year when we had this bullish run, heading into October of 2018 to that Q4 period, it was just the U.S. markets that were bullish. Everything else was kind of iffy. That's not the case right now. In this case, everything's going. It's a broad-based rally when you look at it from a foreign perspective. Everybody's participating, and you got some big moves in some of these emerging names, and that's a really, really good sign. Again, a sign that we're closer to the beginning of a long-term move more than towards the end of a long-term move. What's kind of getting lost in some of this, the trade news, is the inflation data. We've had CPI and PPI over the last couple of days. The PPI is here without the regular PPI is at 1.1%. It's not very strong. And then you look at the CPI, and you look at its year-over-year growth, because that's the key number that we look for. You can see it actually did jump up yesterday up to 2.1%. So, but still is relatively tame. That's the biggest indicator that came out. Of course, it got lost in the shuffle. Tomorrow, it might come back into play when you see some of these import and export prices and retail sales. Again, watch those year-over-year figures. Those year-over-year figures kind of correlate with this, and they peaked in August of 2018. They've been down ever since, and this really rose. The economic surprise index, it's down -4, but still much higher than where it was. But it's those year-over-year figures that are starting to bottom out and roll up, and so it's, again, the macro environment as well is showing that we could be closer towards the beginnings of a long-term run rather than the ends. In August of 2018, these year-over-year numbers were peaking and rolling over, a sign that we were getting towards the end of a long-term run, which we did in October, and especially with commodity prices being as bullish, and commodity prices aren't nearly as bullish. In fact, one last chart we'll take a look at is crude oil, and you can see crude oil is just now getting to the point where we're getting a golden cross. Zoom in a little bit. There's October of 2018, right before we peaked, right? And a lot of these macro indicators were peaking here, and commodities peaked last, and then we really dropped down. Well, the U.S. equities have been rallying all year, but not small caps and not crude oil until now. And this is a really decent breakout type of move on crude oil, at least to the point where we're getting a golden cross this week and a bullish candle that we haven't had for a few weeks. A lot of transition candles transitioning back to a bullish move. So good sign for risk appetite, even if we are overbought in the intermediate term, and we might get some divergence type pullbacks, but nothing that wouldn't halt this long-term momentum that's picking up on a lot of these charts. If we take a look at the sector rotation, we can see a pattern that we haven't seen in a long time, and that is like outperformance by the energy sector. It's been so beaten up, and it might just be a short-term phenomenon, but as you'll see with today's trade idea, there might be some breakouts occurring. Obviously, your safe haven areas over the past week, including today, all underperforming. Real estate's getting hit hard, down 2.5%. Utilities down almost 1%. Staples. Remember, there's a safety trade. There's an interest rate sensitive section of communication services that's in there too, as well as the FANG stocks, or some of the FANG stocks. Healthcare, which has been a big winner, is pulling down. But look at these cyclical areas all taking off, especially energy stocks. Big move higher. If you take a look at the long-term chart, because energy is really the only one that's in a death cross and has been it has been a bear market, along with the emerging markets. It's really since October for energy, but since January of 18, the energy market has been in a bear market. U.S. stocks haven't, but energy has. And you can see energy had a good run early this year, but unlike the stock market, which reached new highs and then a new high and then a new high, we got progressively lower highs in energy. And it looks like we're trying to build a base here, and we could be breaking out and starting to move higher to the upside off of this little divergence. If you look at the candle, this trend, you can see it's a descending triangle that might, in this case, actually work out to be a reversal pattern. Because here's our trade idea. On EOG, if we take a look at EOG, very similar, also has been in a bear market. It's gone from 130 all the way down to 70, so lost 50% of its value, down to 65 actually. So it's lost 50% of its value since peaking in early October 2018. So that's when the stock market peaked. So I mean, it followed the pattern, but then bear market. But the nice good sign is, look at that breakout candle this week, getting above the 50-day moving average, starting to work to fill in the gap between the 200-day. There will be some resistance here, but the PPO, if you take a look at that PPO, that's about as bearish as it's been. Outside of the big time bear market that we had in 2008, 2009. So that just kind of shows. I mean, we were more bearish on a long-term basis here than we were in when we had that death cross in the broad market in early 2016. So big divergence between the sector and the market as a whole. Opportunity for that divergence to turn around and catch back up, at least to where the S&P is. If we look at it on the market forecast, well, let's look at the Bollinger Bands first for EOG. You can see that we broke above the lower end of the value area, and we broke above this big volume node that we were kind of stuck in the last few days. It's a good breakout above the upper Bollinger Band, low bandwidth, pushing up to the upside. We got that big gap here in the middle to play. If you look at the market forecast chart and the 3 green arrow chart, bullish patterns on both. So 3 green arrows and or dark green shading and a green line. You look at the 3 green arrow chart, it's getting us, oops, I hate when it does that. It's getting us 3 green arrows and an upward trend moving average, breaking above all these highs here. You take a look at its Ichimoku cloud, and you see that we're breaking above. See all these other times. Here was one day we broke above the cloud and then came down. Here it looks like it's a little bit more of a sustainable move to get above the cloud, and the green line's crossing above the blue. So we're starting to get the beginnings of a trend developing here on the Ichimoku cloud. If we take a look at the DMI right here. Nope, not that one. It is right. Where'd it go? It's one of these. There we go, DMI. And pull up EOG. You can see we crossed above 25 in the positive, below 20 in the negative. We've had a really low ADX, which means it is trend ready. I mean, if we go back to other periods where we've had such a low, below 10 on the ADX, it was all the way back in here into July of 16. And look at, in this case, it happened to be a bullish move going in, and then this really sideways consolidation that brought the ADX line down. And look at the move you had coming out of it. So this is July of 16, eventually peaking in December of 16. So in 5 months we had a run here. In 5 months we had a run. 138 days we had a 38% move higher in the stock, which was 100% annualized return. That's a really good move. Now, granted, we peaked there, of course, and what was that? 2000 and the end of 16, going into 17, and we had some declines before rallying. But this is a little different scenario because we've been so bullish now. We've been so bearish here that if we start a good bullish run out of this really low ADX, there's some opportunity for a move up to 100 or more really, really quickly, because there's not as much volume in this area as you saw on the daily chart. So for our trade idea, I wanted to take a look at selling this 82.5. So if you see where first of all, buying the 80 call option, which is out of the money, but then paying for some of that $1.83 with this $1.13 82.5 call. If you notice when I do that, the 82.5 call here, let's look at EOG. The 82.5 call is right in the middle of this node. And you can see that the by January expiration, 84.70 is within 1 standard deviation. So this is what it looks like. There's the maximum gain we have. And here, let's get rid of the, this is the trade that we already put on. So we got $1,000 risk, which we'll cut in half by getting out early if we do pull back down. But if it does go up, a $2,700 potential reward for that $500 of risk, about a 5-to-1 plus risk reward ratio, or reward to risk ratio is exactly, it's a good opportunity if the stock just makes it up into this area here where there's very, very little resistance to keep it from getting there. Of course, nothing's 100%, but nice, good breakout move has and the potential for a good trend. And usually, as you saw, those trends start with good, strong overbought moves. Let's see if we can't take advantage of a good, strong overbought move to start a really good trend on this stock. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Let's keep this conversation going in between videos in our Market Outlook forum on marketscholars.com. You can be able to interact with other market scholars, other people who watch these videos day in and day out. Open up any new thread with any questions or comments you have from me or anybody else about what we talked about today, or for that matter, anything we didn't talk about that pertains to the topic, of course. Open up any new threads. Feel free to reply to anybody else's thread too. It's meant to be a forum. It's meant to be a dialogue, conversation going back and forth. So let's keep that going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content in between these videos from day to day. And join our site at marketscholars.com for free, as I showed you before, and our Market Outlook Facebook group that we've created. Have a great rest of your evening, everybody. Thank you again for watching, and we'll see you all tomorrow.